Good morning, everybody. How are you today?
Good morning, Professor.
Good. How about you, Professor? Good.
Good. It's good to see you all here today. Um, so let's slow down a little bit today. Um, let's take a look at where we are and where we're headed. Okay, so again, you should be looking at this every couple of days, right? I mean, this should be like a second home for you, this Blackboard page, which really tells you everything you need to know, right? So in terms of exams, we just had one was due last night, right? And the next one is not due for a few weeks, right? So we can breathe a little bit. This exam will be on chapters 3 and 4. Chapter 3 is a tough one. Chapter 4 is not, right? So we're going to spend the next two classes today and next week, and maybe one more, I have to see, on chapter 3, because it's worth that much of our time. Let's look at the homework. All right, chapter 2 was due a few days ago. Chapter 3 is due October 16th, right? So that gives us 2 more classes. And then the homework will be due a couple of days after that. So chapter 3, it's a really important chapter. If you had in your mind somewhere that you might want to be an accountant, it is a really important chapter for that. Let's see. Now, I know we started some of this last week, but I think I'm going to go back to the beginning with this. The other thing, there was a kind of a review sheet here. Okay, about adjusting entries. So, chapter 3 entitled The Accounting Cycle End of the Period. But the main topic within the chapter is what we call adjusting entries. And just to review a little bit, when do we do them? We do them at the end of the period, after the trial balance, but before the financial statements are prepared, right? So we need to take the trial balance and adjust it. Not every account, just some. And, in the textbook world that we're in, they basically tell you what adjustments need to be made. In the real world, accountants just have to intuitively know what needs to be adjusted. So why are adjusting entries prepared? Because we want to bring some account balances up to date. What that really means is that some transactions begin in one period, but they could end in another. Like we could buy supplies in one period, and then later we see that supplies were used, right? So we need to apportion those transactions between the different accounting periods. There are 2 overriding principles that really indicate why we do this. One is called revenue recognition principle, that we record revenue in the period in which it was earned, right? And that's a very important word, earned. Earned. What does that mean? It means you did the work. You did the work. You don't wait until the customer pays you to record revenue. So you record revenue as soon as the work is done, whether or not you got paid. The other one is called the expense recognition principle. We record expenses in the period in which they were incurred, not when they're paid. Now, if they're incurred and paid in the same period, yes, debit, rent, expense, credit, cash, for example. But we might have an expense this period that doesn't get paid till a subsequent period, right? That's how the expense recognition principle works. And the book defines it a little differently. They say that there's a relationship between expenses and revenue. So you record expenses in the period in which the revenue was earned, that those expenses helped you to earn. So there's a relationship between expenses and revenue. We don't have expenses just for the sake of having them. We have expenses only in as much as they help us to produce more revenue. Are all accounts adjusted? No, right? And the big thing to remember, never, ever, ever, ever adjust cash. Never adjust cash. If you're thinking cash, you're wrong. Can't be. Another thing to remember, every adjusting entry, right? There's going to be two accounts, one debit, one credit. One of those accounts is going to be an income statement account, a revenue or expense. And the other one will be a balance sheet account, an asset or a liability. And then we said that adjusting entries fell into two major categories. The first one being what's called deferrals. And what were deferrals? We have numbers in the accounts that need to be changed. So when you look at the trial balance, you're going to look at that list of accounts and you're going to say, okay, some of these need to be changed, right? And you'll see which ones they are, right? For example, something like prepaid insurance, prepaid rent, prepaid advertising, anything that's prepaid, right? Supplies, depreciation. That comes up under something called prepaid expenses. Prepaid expenses are originally recorded as assets, but over time, they change. They expire. Something like insurance and rent would expire. And other assets like supplies, for example, they get used up. And what's the difference between supplies and depreciation? Well, supplies is an asset with a very short life, and depreciation applies to things like equipment that have a much longer life. So what's the difference between something like supplies and equipment? Supplies have a very short life, and equipment has a longer life. And we'll see that later. We're going to look at the balance sheet again, and we're going to see that we're going to put things into different categories, and you'll see the difference between something like supplies and equipment. What adjusting entry gets made? We're going to debit an expense, insurance expense, rent expense, advertising expense, and you're going to credit the asset, prepaid insurance, prepaid rent, prepaid advertising, right? And the other thing it says here, you could also credit something called a contra asset. The contra asset is something that applies to depreciation, right? So we'll see it when we get to it. The other type of deferral is deferred revenue. And this is the crazy thing that happens when the customer pays us in advance. Pays us in advance. And go back to chapter 2, we had the example with the sewing shop, and the one customer, Bob, paid in advance to have his suits altered. Right? And when that happened, the store owner debited cash and credited, not revenue, deferred revenue. Right? Why couldn't the store owner credit revenue? Because no work had been completed. You can only credit a revenue account once work has been completed. If the customer pays you before you do anything, it's not revenue. So what is deferred revenue? This happens when a customer pays in advance. It's originally recorded as a liability. It becomes revenue once the service is performed. So the adjusting entry is a debit to deferred revenue and a credit to service revenue. The other main category is what we call accruals. What are accruals? Well, something has happened, but it hasn't been recorded. It should have been, but for some reason it was not recorded. We have accrued revenue and we have accrued expenses. An example of accrued revenue, we have revenue that was earned, but maybe we didn't send out a bill yet to the customer. All right, so if I do work, let's say my normal practice is to do work today and send out my bills tomorrow, right? Today is September 30th. I do the work today, but if I don't send out that bill till tomorrow, tomorrow's October 1st, I'm into the next month already. I have to record revenue in the month that I did the work. So what entry would I make? I would on the 30th, right? On September 30th, I would debit accounts receivable and credit service revenue. We could also have accrued expenses. We bought something or we used something now, but we don't pay for it until later. So examples would be something like getting a telephone bill in September, but not paying it until October. The interest on borrowed money that doesn't have to be repaid until a later date, or salaries is another example. So I get my telephone bill today, September 30th, and Verizon says, okay, this is what you did in September. This is how much telephone you used in September, right? You made calls, you had this many texts, this much data, right? However they calculate your bill. All this crazy taxes and other crazy fees that are on your cell phone bill. Do you ever look at that thing? Right? So Verizon sends me the bill. I get it today, but they say you don't have to pay it until October 10th. Well, I got the bill today. The bill is telling me all the charges I had for September. So I have to record that expense in September. So I would debit utilities expense and credit either, you got to see what the problem is telling you, right? I would credit either accounts payable, or sometimes they might even be more specific and say, why don't you credit utilities payable? Why am I crediting accounts payable? Because I owe that money to Verizon. I use the phone in September. It's an expense of September, but I don't pay it until October. So as of September 30th, I owe that money to Verizon. Interest is another one. You know, I borrow money, say, on September 1st, but I don't have to pay it back until January 1st, right? I have 4 months to pay it back, principal plus interest. Well, every day that goes by, interest is accumulating on that loan. You know, if you took student loans to go to college, right, you got the loan to pay for the fall semester, but you're not going to pay that money back until maybe, a year after you're out of college, which could be years from now. But what do you know is going to happen between now and then? Interest is going to accumulate on that loan. So, you know, in your own personal life, it doesn't matter so much, but in a business, it does. In a business, you want to say, okay, well, if I borrowed money in September, I have interest expense on that money, even though I don't have to pay it back for a while. So the adjusting entry is to figure out how much the interest is, debit interest expense, credit interest payable. Salaries. How does salaries work? Well, salaries, you know, most people get paid on Friday, but not every month ends on a Friday. So today is September 30th. It's Wednesday. If you get paid on Friday this week, that's October 2nd. That October 2nd paycheck is going to include what? It's going to include 3 days in October. Those 3 days are salaries expense in October. Expense recognition principle. I need to get those salaries expense into September. So debit salaries expense and credit salaries payable for the 3 days pay in September. Monday, Tuesday, Wednesday, September 28th, 29th, 30th. And then, you know, they don't show you the entry that's made in October, but in October, what are you going to do? When you pay that salary on Friday, October 2nd, what are you going to do? You're going to debit salaries expense for 2 days, October 1st and 2nd, Thursday, Friday. You're going to debit salaries payable for the 3 days that were in September, and you would credit cash for the 5 days, right? So that's how that's handled. But in this chapter, they're really only interested in this entry. Right? And that's it. I say that's it, right? So now we got to just go through the motions here of doing the problem. Where did it go? It disappeared. Let's see. Okay, so I'm going to do the chapter 3. Well, yeah, I do it differently. Remember, when you do the problem, you're going to have different numbers. When I show it to you, I show it to you exactly like it is in the textbook. So I think we did some of this last time, but I'm going to do it again. Right? So this problem in the textbook, let's see, which one was this? Okay, this is chapter 3. In the book. Okay, this problem is on page 161 in the book. It's problem 3-3A. Right, so if you want to look, but here it is right here in front of you. So Gamecock, the information necessary for preparing the 2021 year-end adjusting entries, right? So that's important, the year-end adjusting entries. So here, we're adjusting a 12-month period of time. So we have to be conscious of that. For Gamecock Advertising Agency, this is an advertising agency. Appears below, the year ends December 31st. Record the required entries on December 31st, 2021. No prior adjustments were made. Okay, so let's take a look at this first one. All right, now remember, they have the date in here, December 31st. This is when we're making the adjusting entry. So let's see. And again, the way I like to look at these, there's two things at work here. One is to know the accounts that are being debited and credited. And then secondly is the amount. So let's take a look at this one, for example. Let me see if I can blow this up a little bit. On July 1st, 2021, Gamecock receives $6,000 from a customer for advertising services to be given evenly over the next 10 months. Gamecock credits deferred revenue. Record the adjusting entry for deferred revenue at its year end, December 31st, right? So on July 1st, they debited cash and they credited deferred revenue. It's now 6 months later. 6 months have passed. The advertising services were given over that 6-month period evenly. Right? In other words, they didn't do more 1 month and less another month. Right? They say it's evenly. So now we want to say that not all, but some of this $6,000 has been earned as revenue, right? Over time, it becomes revenue as the services are provided. So we want to debit deferred revenue and we want to credit service revenue, right? So that takes care of that part of it. Now, what about the amount? Well, $6,000 over 10 months is $600 a month. How many months is it from July 1st to December 31st? It's 6 months. $600 a month times 6 months is $3,600. Right, so that takes care of that one. Right, and then we'll see later if the answers are correct. At the beginning of the year, Gamecock's depreciable equipment has a cost of $28,000, a 4-year life, and no salvage value. So really what that means is that we bought equipment, we paid $28,000 for it. We expect to use that equipment over a 4-year period of time. And at the end of the 4 years, it won't be worth anything. We'll just throw it away. The equipment is depreciated evenly over the 4 years. Record the adjusting entry for depreciation at the end of the year, December 31st. So what adjusting entry do we make for depreciation? We debit depreciation expense, right? Debit expense and credit contra asset, accumulated depreciation. Now for the amount. 28,000 divided by 4 years is $7,000 a year. Okay. All right. On May 1, the company pays $4,800 for a 2-year fire and liability insurance policy and debits prepaid insurance. So on May 1st, 2021, they debited prepaid insurance and credited cash. Now it's December 31st. Now we have to record how much of that insurance policy has expired, how much time has passed. So we're going to debit insurance expense, and we're going to credit prepaid insurance. So those are the accounts: debit insurance expense, credit prepaid insurance. Now we got to figure out the amount. Now, there's a couple different ways you can do this. If it's a $4,800 policy over 2 years, 4,800 divided by 2 is $2,400 a year. 2,400 divided by 12 months is $200 a month. How many months is it from May 1st to December 31st? It's 8 months. So that is 8 months times 200 a month is 1,600, right? So that's one way you could do it. Another way you could do it is you could say, okay, 8 months have passed out of 24 months, right? It's a 2-year policy. That's 24 months. 8 over 24 is 1/3. And what's 1/3 of 4,800? 1,600, right? So there's a couple different ways you could do the math for that. Oh, what happened? 2 people got bounced. Okay, here we go. September 1st, 2021. The company borrows $20,000 from a local bank and signs a note. Principal and interest at 12% will be paid on August 31st, 2022. So that's a year. We're borrowing the money for a year, and we don't have to make any payments till August next year, which is 12 months. Record the adjusting entry for interest at its year-end December 31st. Right? So debit interest, expense, and credit interest payable. Okay, now let's figure out the interest. Again, there's a couple different ways you could do this. You could say principal times rate times time. $20,000 times 12% times 4 months over 12, because September 1 through December 31 is 4 months. Another way to look at it is you say, well, 12% a year divided by 12 months is 1% a month, and 1% a month times 4 months is 4%. So what's 4% of 20,000? It's $800. Okay. Now I'm going to do that on my calculator. I just did that in my head, and this early in the morning, right? Sometimes the circuits aren't all working right. So let's see, 20,000 times 4%, $800 is right. I think it's right. We'll see later. Okay, supplies. At year end, there is a $2,700 debit balance in the supplies account, but only 1,000 of supplies actually remain. Record the adjusting entry supplies at the end of the year. Right? Now for supplies, the entry that we make is debit supplies expense and credit supplies. Now the amount. Well, at one point we must have had $2,700 worth of supplies, but today, December 31st, we only have 1,000. So what must have happened? If I had 2,700 to begin with, but I only have 1,000 left, that means 1,700 aren't there anymore, right? And the assumption is that the 1,700 were used legitimately, right? Someone just didn't take them home and take them for their personal use. So debit supplies expense and credit supplies, $1,700. Okay. Now here's all the entries together, and see how you have an opportunity if you wanted to change, to edit them, right? But let's score the answer and see how we did. And everything was done correctly, right? So this was deferred revenue. Right? This was prepaid expense. This was prepaid expense. This is accrued expense. This is prepaid expense, right? If you want to go back to my notes and, see which category they come under. But you don't really even have to do that, right? Because, let's face it, this seems like it's a very long, complicated, difficult topic. And yes, to some degree it is. However, you'll see that there are altogether maybe something like 10, 11, 12 different adjusting entries. That's it, right? It's not like this endless sea of entries. And they tend to be similar and they tend to repeat themselves. Okay, so let's look now. Let's look now at the next problem. Buzzard bicycles, which is problem 3-4A, which is also on page 161 in the book. Okay, so we have 6 entries again. You're going to see some of them repeat. Here's an insurance. Here's a deferred revenue. Here's supplies. Here's interest, right? You see they repeat themselves. So Buzzard Bicycle specializes in custom painting and design of bicycles. December 31st is the company's fiscal year end. Information necessary to prepare the year-end adjusting entries appear below. Record the necessary entries on December 31st, right? So let's take a look at the first one. A 3-year fire insurance policy. Now, the other problem was a 2-year policy, right? This is a 3-year. A 3-year fire insurance policy was purchased on July 1 for $18,000. The company debited prepaid insurance for the entire amount, right? Debit prepaid insurance and credit cash on July 1st. It's now December 31st. 6 months have gone by. So how much insurance has expired over that period of time? Debit insurance expense, credit prepaid insurance. Okay. Now, from July 1st to December 31st is 6 months. 6 months out of 36, because it's a 3-year policy. So you could multiply $18,000 times 6 over 36, right? You could do that if you want to, or maybe there's an easier way to do it. If it's an $18,000 policy divided by 3 years, that's $6,000 a year. And if I take $6,000 and divide it by 12 months, that's $500 a month. And this is 6 months. So 6 months times $500 a month is $3,000. Right? $3,000. You could take the whole $18,000 and divide it by 36 months, right? And you should come out to $500, and then $500 times 6 months is $3,000. Salaries. Employee salaries of $25,000 for the month of December will be paid in early January, right? Just like this month, right? Just like this month. This month, we're going to pay everybody on Friday, but Friday's October 2nd. October 2nd, that paycheck will include 3 days in September and 2 days in October. So this is a similar situation, right? We need to debit salaries, expense, and credit salaries, payable. And we got lucky. We don't have to calculate anything. They gave us the amount. Right? Some problems we may have to calculate the amount, but they would have to tell you more if they wanted you to calculate the amount. Okay. On November 1st, the company received $6,000 in cash from a customer requesting a custom design for 6 identical bikes. $1,000 each, right? $6,000 for 6 bikes, $1,000 a bike. Deferred revenue was credited for the entire amount. So when the customer came in on November 1st, the customer handed you $6,000, you debited cash, and you credited deferred revenue, right? Why deferred revenue? Because you hadn't done any work yet. Debit cash, credit deferred revenue. But now, at the end of December, 4 of the bikes have been completed. 4 bikes, $1,000 a bike is $4,000, right? Debit something, 4,000. Credit something, 4,000. Now, our business is making bicycles. So when we make bicycles, that's how we make revenue. Now, the fact that the customer paid me in advance means I have to now debit deferred revenue. Okay, supplies. Now, I know from the past that the adjusting entry for supplies is a debit to supplies expense and a credit to supplies. Right? So that means now when I read it, I can concentrate on the numbers. So at the beginning of the year, I had $2,000 of supplies. And during the year, I purchased $18,000 more. So 2,000 plus 18,000 is 20,000. But at the end of the year, the supplies remaining were 4,000. So what's the difference between 20,000 and 4,000? It's 16,000. So what must have happened? You know, the year started. If you look in my supply closet or wherever I keep them, there were $2,000 worth of supplies in the closet. During the year, I bought $18,000 more worth of supplies. So the most supplies I could have had at any point in time during the year was 2,000 plus 18 is 20. But I don't have 20. I go to the closet and I count what's there, and there's only 4,000 there. Well, if I had 20, 2 plus 18, but now I've only got 4, that means the other 16 disappeared, right? And going on the assumption that no one stole them, that supplies expense, 16,000. Okay. Buzzard paid a local radio station $12,000 for 4 months of advertising on December 1st. The advertising will appear evenly over the 4-month period. The company debited prepaid advertising for the entire amount. So on December 1st, the company debited prepaid advertising and credited cash, right? They paid the radio station $12,000 for 4 months worth of advertising. It will appear evenly over the 4-month period. So what's 12,000 divided by 4? That's $3,000 a month, right? $3,000 a month. How long is it from December 1st to December 31st? It's 1 month. So 1 month is $3,000, right? Debit, credit, 3,000. Well, advertising works a lot like insurance does. You pay for it in advance. So now you want to record the amount that has expired. So remember, with insurance, you would debit insurance expense and credit prepaid insurance. With advertising, you're going to debit advertising expense and credit prepaid advertising. Interest again, right? As soon as I see they borrowed money, interest, record the adjusting entry for interest. Now for interest, what are we going to do? Debit interest expense and credit interest payable. As soon as you see that, that's what you do. So now we're going to figure out how much interest has accumulated on that loan. Now here they're telling you, look, Buzzard borrowed $36,000 on March 1st. The principal is due in 5 years, but they have to pay the interest each year, each March 1st, at an annual rate of 10%, okay? All right, so here, $36,000 times 10% is what? It's $3,600. 36,000 times 10% is $3,600. Every year we have to pay them $3,600. But day to day, month to month, interest is accumulating on that loan. So how much interest has accumulated on that loan from March 1st through December 31st? How many months is it from March 1st to December 31st? It's 10 months. It's 10 months. So if the interest is $300 a month times 10 months, the interest will be $3,000. Okay, and you could multiply it out. You could say 36,000 times 10% times 10 over 12, right? And you could do it that way, or you could say, okay, I have to pay 10% interest every year, 36,000, 10%, $3,600. That comes out to $300 a month. How many months have passed, right? So here's all the entries again. Take a look at them. If you want to change anything, you can. right? And let's score the answer. And looks like I'm on a hot streak today, right? I got these all right again. Okay. This is, yeah. Somebody have something to say? Anybody have a question? I thought I heard somebody start to say something. No? Okay. All right, this next problem is a little different. In this problem, they're giving us an adjusted trial balance. And in other words, we made the adjusting entries, we put them in the accounts, we took another trial balance, and here's the numbers. And they're asking us to prepare an income statement, a stockholders' equity statement, and a balance sheet. But notice now they call it something different. They call it the classified balance sheet, right? So maybe we should go back to the book and take a look. We are in chapter 3. Right, and prepare financial. So here, right, this was the example in the textbook, right? And sometimes you should go to the book and take a look at what they're, what they're asking you to do. Okay. Here's the adjusted trial balance. Just like the problem we're going to do next, here's the adjusted trial balance. Do an income statement first, owner's equity statement next, balance sheet last. Notice the balance sheet. The balance sheet now, we're going to refine it. We're going to put the assets and liabilities into two categories, current and long-term. Stockholders' equity is the same. Stockholders' equity for us in our class will never change. It will be the same every problem we do. Common stock, retained earnings. Now, you still have to calculate retained earnings. Don't get me wrong. Sometimes you have to calculate retained earnings. But stockholders' equity is just common stock and just retained earnings. But look at the assets and liabilities, right? Current, long-term. So let's talk about the liabilities first, because I think this is easier to understand. What's a liability? A liability is when you owe something to somebody. Usually it's money, right? You bought something that you didn't pay for, you're going to pay for it later, right? That's really what a liability is. Or if you want to even be a little bit broader definition, a liability is a promise. You promise to do something for somebody. So if you buy something and you don't pay for it now, you promise to pay for it later. If the customer pays you in advance to do something for them, you promise to do that in the future. That's what deferred revenue is. So liabilities are usually easy to identify because they have the word payable in their name, right? Accounts payable, salaries payable, utilities payable, interest payable.
Excuse me, this. Hey, let me just say. No. Final word. Well, it's hard to get any word in with this clown. Excuse me, this. Hey, let me just say. No. The final word. Well,
hello? Anybody have something to say? Hello? Okay. Let me see something. Okay. I think we have everybody who's supposed to be here is here. All right. So the liabilities are broken down into current liabilities and long-term liabilities. Now, what's the difference between current and long-term? Anything that's current is going to happen within the next year. Anything that's going to happen within the next year. So a current liability is a liability that's going to be satisfied within the next year. Long-term liabilities, you have more than a year to satisfy. So this note's payable. This is telling me that I'm going to probably pay this money back in 2, 3, 4, 5 years. I mean, I'd have to read the problem and see what it says, right? But all these liabilities are going to be paid off within the next 12 months. These are going to take longer than 12 months to pay. What about assets? We have current assets and long-term assets. So current assets are, by definition, assets that are cash is cash, will become cash. Accounts receivable will become cash when the customers pay. Remember, accounts receivable, the customers owe you money. You did something for the customer and they didn't pay you yet. They're going to pay you later, right? So our cash will become cash or will be used up or consumed within the next year. So these supplies, right? These have a very short life. The prepaid rent, this is going to be gone within a year. So current assets, just like current liabilities, you have a 1-year time frame. Anything that you expect to keep longer than 12 months is a long-term asset. So this equipment, when we bought it, we intended to keep it for multiple years, right? Again, you have to read the problem, see what it tells you. You could never have equipment in the short term, right? By definition, something like equipment has to be at least 2 years or longer. Could be 2, 5, 10, 20, 30, right? Whatever the problem tells you. Now, is there anything different on the income statement? No, income statement looks the same. Stockholders' equity statement looks the same. Balance sheet, that's what's different. You've got this current and long-term, categories for assets and liabilities. So let's go back to the problem if we can. Oh, come on. I have to do this to get through. I don't know why it does this. Okay. So here's this problem now, right? So we're going to do an income statement, a stockholders' equity statement, and they tell us some things about the stockholders' equity statement to make it more complicated than it needs to be. And a balance sheet, but now remember, they're going to call it the classified balance sheet, and that means we're going to divide the assets and liabilities into current and long-term. So for an income statement, look how they kind of give you an outline, right? Revenues, expenses, total expenses. So what are the revenues? Notice we have 2 revenues. Now, this is a company that specializes in building new homes and remodeling existing homes. Remodeling projects include adding game rooms, changing kitchen cabinets, countertops, updating bathrooms. Below is the year-end adjusted trial balance. Okay. So that's the nice thing about the trial balance class. Look how it's laid out. All your income statement stuff is down here. Look, it's all here. All we got to do is take these numbers here and just put them down below. All your balance sheet accounts are up here. Here's your assets. Here's your liabilities, right? And look, notice the notes payable is due in 5 years. That's telling me that's long term. And then you've got your stockholders' equity accounts, your common stock and retained earnings, and I guess dividends will figure in there too. So let's do the income statement first. You always do the income statement first. And let's see. Let's see how they want this. Service revenue, new construction, and service revenue remodeling, right? We break it down into two categories. And let's see, that's 450 and 280. 450,000, and that's 280,000. Right? And they're nice and they added it up together for you. So you got total revenue of 730,000. All right, new construction revenue, remodeling revenue, total 730. Now expenses, let's just go back. We've got salaries, 160. We've got supplies, 285. We've got supplies expense, right? Supplies expense. Remember, what goes on an income statement? Revenues and expenses, right? Revenues and expenses. So we look for the word revenue, we look for the word expense. Supplies, depreciation. Insurance. Utilities. Interest. And this last one, service fee expense, whatever that is. Yikes, $73,000. Okay, now they didn't do it all. They totaled up the revenues, they totaled up the expenses, and now we have to figure out net income, right? So 730 minus 644. I'm getting 86,000. So net income is $86,000, right? And okay. Now let's go back up here again, and they gave us. Now again, we're going to do stockholders' equity statement next, and they laid it out already. Common stock, retained earnings, total. Now they did some tricky thing in here, so let's read what this says. Prepare the statement of stockholders' equity for the year ended December 31st, 2021. Note, during the year, the company issued an additional common stock for $30,000. This amount is included in the amount for common stock in the adjusted trial balance. Okay, so when I go to the adjusted trial balance, this $200,000 includes the 30. So in other words, the ending balance is 200,000, which means that at the beginning, it should be 170, right? Now, we're going to add 30,000 to the 170. Issued common stock, see? 30. Now, what about retained earnings? Retained earnings, the number doesn't change until we change it. So retained earnings, this 31,000 is the number that goes there. Beginning balance, 31. What do we know increases retained earnings? Net income. We just calculated net income to be, right? If we go back and look at the income statement, we just calculated net income to be 86,000. So net income is 86,000, and we have dividends. The dividends get subtracted. So if you go back to the trial balance, you'll see that the dividends were 26,000. Okay, and they didn't calculate the amount, so we have to do that. So let's do that. 31 plus 86 minus 26 is 91. Right, let's add across. 170 plus 31 is 201. This is 30. This is 86. This is 26. Right, so this should be 291. Right, 200 plus 91 is 291. But let's add the column up just to make sure. So 201 plus 30 plus 86 minus 26 is 291. Okay, so that takes care of that. So we took care of the income statement. We took care of the statement of stockholders' equity. And now we're on to the balance sheet, number 3. So they kind of lay it out nice for you. And they're telling you here, prepare the classified balance sheet. Amounts to be deducted should be indicated by a minus sign, right? That's going to be this accumulated depreciation. That'll be over here somewhere. So let's just go back and just look at the order. Which are the current assets? Cash, accounts receivable, supplies, prepaid insurance. All of these assets have a life of a year or less. Long-term assets, we just have the one, equipment. Okay, so let's come back here. Cash, 16,000. Just take them in the order you see them. Cash, 16,000. Accounts receivable, 25,000. I think supplies was the next one. Supplies was 32,000. And prepaid insurance was the last one. Okay, long-term assets. Equipment. How much was the equipment? Equipment was 625. Right, less accumulated depreciation. Right, now they say to put a minus sign in front of things that need to be subtracted. So accumulated depreciation is always subtracted on the balance sheet. So it is 200,000 minus, right? Minus 200,000. So total assets, 505. Now yeah, okay. This is the way they like to do it. Now stockholders' equity. We can just put those numbers in already. We already know what those numbers are, right? Common stock and retained earnings, right? And this was 200. And this was 91, right? That came right off the stockholders' equity statement, right? If you don't remember, go back and look. 200, 91 is 291. So we're left with the liabilities. So if we look at the liabilities, all the payables, right? Accounts, salaries, utilities, those are all current, and then the note is long-term. So let's see, accounts payable. Accounts payable was 31,000. Salaries payable was 28,000. I think utilities was the next one. Utilities payable was 5,000. Okay, and then for long-term liabilities, you had notes payable, and that was, I think, 150. 150. Okay, so now let's stand back and take a look. Right, the total assets is 505. The total liabilities and stockholders' equity is 505, right? Beautiful, beautiful. So it looks like we got it all right the first time. Let's score the answer. Everything correct. Everything correct. This was a little sneaky the way they did this here, right? So you got to pay attention a little bit for that. And everything looks right over here. So we're in very good shape. This came out very well. And it's, you know, good practice. We haven't done statements since chapter 2, so it's been a week or so. So anyway, there you go. And again, the new concept is this current versus long-term, right? Current assets versus long-term assets, current liabilities versus long-term liabilities. What happened? Did you guys get bounced? Okay. All right. Now, the next problem is a very long one, right? So I don't want to start it because it's going to take at least a half hour to do, and I don't want to rush through it. When we do it next week, I want you to be fresh, right? Because now your eyes might be bobbing up and down in your head a little bit. So let's see what else we can do today. Now, there was something else here that I wanted to show you. Let's go back to the table of contents and see. All right, let's review the chapter a little bit. Okay, so these are the learning objectives in the chapter. And normally, you know, we don't look at it this way, but I mean, effectively, what did we learn how to do? We understood that expenses get recorded when they're earned, revenues get recorded when they're earned. That's the period in which we provide goods and services to the customers. Not necessarily when cash is received, right? That's why we could have accounts receivable. That's why we have deferred revenue. Expenses are usually recorded in the same period that the revenues were recorded that they helped to generate. Or another way I like to look at it is we want to match the revenue to the time period in which they occurred. So that was your revenue recognition principle, your expense recognition principle. That is the accrual basis of accounting. So by definition, if we record revenues when they're earned and expenses when incurred, we're following the accrual basis of accounting. In other words, the time period matters. And we want to get all the revenue in the time period that it was earned, and we want to get all the expenses into the time period in which they were incurred. As opposed to cash basis accounting, which we don't follow. Cash basis accounting is not considered generally accepted accounting principle. Small businesses may follow it, but big businesses do not. On the cash basis, you only have revenue when the customer pays you, and you only have expenses when you write the check, right? Which may make more sense to you because most of us live our personal lives that way, right? But if you're doing accounting for a company, you're supposed to follow accrual. We talked about why we need to make adjusting entries and how we make adjusting entries. The adjusting entries, just like any other journal entries, get posted to the accounts, and then we have to prepare an adjusted trial balance. Right? Now, the problem that we just did, Boilermaker, I think was the company's name, they gave us the adjusted trial balance. Right? But just understand that those numbers included the adjustments. So we don't prepare the financial statements until the adjusted trial balance is prepared. So that's what this number 5 says, prepare financial statements using the adjusted trial balance. That's the exact problem. Look at these last two. Closing entries. Demonstrate the purposes and recording of closing entries. And then we post the closing entries and prepare the post-closing trial balance. So over the life of our work here, right, the process involves 3 different trial balances. We go through the month, we enter the transactions in the journal, we post them to the accounts at the end of the month or the end of the year, whatever time period we're working with, we stop and we take a trial balance. And again, what's the purpose of the trial balance? To show that debits equal credits. Then we adjust. Make the adjusting entries in the journal. We post them to the accounts. We take another trial balance. This time we call it the adjusted trial balance. We prepare the financial statements. And then we go through another set of entries called closing entries. Post them to the accounts, and then take a third trial balance called the post-closing trial balance. Right? So let's see if we can take a look at the closing entries. Now, why do we need to have closing entries? Well, some accounts are permanent. The assets, liabilities, and stockholders' equity accounts are permanent. That means by permanent, we carry balances forward from one period to the next. But other accounts, revenues, expenses, and dividends are considered temporary accounts. Think about it for a second. Go back to the income statement that we just did. What does it say on the heading? Name of the company, income statement for the year ended December 31st, 2021. Here's the revenues, here's the expenses, here's the net income. When that period's over, I have to take those accounts and set them back to 0. They must start out the next accounting period with 0 balances. Again, not all the accounts, just the revenues, expenses, and dividends, right? So when I look at an income statement for 2020 or 2021, those numbers just apply to that period. When I look at the income statement for the next year, those numbers just apply to that period. Now, if I don't close the accounts out, let's say I did a 2020 income statement, revenues minus expenses, and I didn't close the accounts, and then I did a 2021 income statement, that 2021 income statement would include 2020's numbers plus 2021's numbers. I don't want that. So whenever I prepare an income statement for whatever the time period is, I need to take the accounts that are on that income statement, the revenues, the expenses, and the dividends, and I need to close them. Close them means make them zero. At the same time, when I'm doing closing, there's a second purpose. The second purpose is to update the balance in the retained earnings account. Because up to now, we don't touch retained earnings, right? We know that net income increases retained earnings. We know that dividends decreases retained earnings. And when we do the statement of stockholders' equity, we know that. But we don't record anything into the retained earnings account. This is the one time you do when you make the closing entries. The closing entries will update the balance in the retained earnings account, right? So if you look at the problem that we just did, the balance of retained earnings on the adjusted trial balance was really the beginning amount of retained earnings. I forget the number. I think it was 31,000, was it? Right? And then we saw that net income increased retained earnings by 86,000, and we saw that dividends decreased retained earnings. I think the number was 26,000. The ending retained earnings was $91,000. If I take that $91,000 and look to see if that number is in any of my accounts, it's not. So that ending balance of retained earnings only gets changed by closing. So I hope that's not too confusing. That's the only way it gets closed. So now let's take a look at closing entries and how they work. There are 3 entries. Only 3 entries. The first entry is to close out the revenue accounts. Now, what does that mean, close out? When you hear the word close out, it means make it zero. Make it zero. So if I want to make a revenue account zero, what do I have to do to it? Revenue accounts have credit balances, so if I want to make a revenue account zero, I have to debit it. So in this case, and again, this is the example in the textbook. What page is this on? Can't see. Well, it's here where it says learning objective 3-6. For some reason, it's not giving me a page number. So debit service revenue, that'll make the revenue account zero. And let's take that $7,200 and put it into the retained earnings account on the credit side, right? Because what happens? Because revenues increase retained earnings. What about expenses? Okay, well, expenses have debit balances. So if I want to make them zero, I have to credit them. So I'm going to take all the expenses that I had. And the best way to do this is if you have the income statement in front of you, because you have all these numbers are already on the income statement. If you don't have an income statement for whatever reason, you can use a trial balance, the adjusted trial balance. So we credit each of the expenses separately, right? Rent, supplies, depreciation, etc. That'll make the balances in those accounts zero. Debit retained earnings for the total expenses, the total expenses. So if you're working with an income statement, you know this number. If you're working with a trial balance, you just have to add these numbers together. That's entry number 2. Entry number 3, close the dividends account. Now the dividends account has a debit balance, so to close it, you have to credit it. Debit retained earnings. Right? Now, when you're finished with all of this, the revenue accounts are zero, The expense accounts is zero. You got your net income into your retained earnings account, right? Because the revenue now it sits in the retained earnings account on the credit side. The expenses is in the retained earnings account on the debit side, right? And the dividends sit in the retained earnings account on the debit side. So now when you calculate the balance in the retained earnings account, that should equal your ending balance. So here they're showing you in the T account what it looks like, right? Remember, this was a new company. This was the soccer academy, right? Zero was the beginning retained earnings. Whenever a company starts, they don't have any retained earnings. So what are we going to do to the retained earnings account? Well, the revenues got in there by closing. The expenses and the dividends got in there by closing. So the ending balance is $1,000. And this $1,000 number should coincide with what's in the retained earning, what's on the retained earnings statement. Excuse me, the statement of stockholders' equity. So why do we need to have closing entries? Here they are, 2 reasons. We want to transfer the temporary balances into the retained earnings account, and we want to make these balances zero to start the next period. And notice what it says right under there. Closing entries do not affect the balances of the permanent accounts. What are the permanent accounts? They're the assets, the liabilities, and let's say for now, the common stock account, because we saw that the retained earnings account gets affected. Permanent accounts carry cumulative balances throughout the life of the company. Now, once those entries are posted, you need to do a trial balance. So again, here's the example that was in the textbook. Notice that the closing entries are shown in blue. The adjusting entries are shown in red, right? So if you want to go back and look at the whole example, this was the soccer academy again. So these are all the transactions. What you see in black is the stuff that happened day to day in the life of the business. The red entries are the adjusting entries. The blue entries are the closing entries. And notice that when you're finished with everything, the revenue account has a zero balance. The expenses, right? Look at all the expenses. They're all zero. The dividends is zero. And retained earnings is now the correct balance. And that is the number that you should wind up with when you do your stockholders' equity statement, right? In that retained earnings column, that's the number that you should wind up with. Notice that some accounts don't change, right? So cash doesn't change, right? Accounts receivable is adjusted, but there's your balance, etc. So if we did another trial balance now, what accounts should be on this last trial balance? That's what's called the post-closing trial balance. What accounts would you expect to see on there? You would see the assets, the liabilities, and the stockholders' equity accounts, common stock, and retained earnings. And the retained earnings number now that you see is the right number. All right, so here it is. Here's what the trial balance looks like now. Notice there's no revenues, there's no expenses, right? There's no revenues, there's no expenses, there are no dividends. All the numbers that you see here are the numbers that appeared on the balance sheet. Right? And notice the retained earnings, they put in a different color to stand out that this now represents the updated balance in the retained earnings account. So that's why you need to have closing entries, because you need really, yes, you need to make those accounts zero, but otherwise retained earnings, the balance will never be right. right? And here's just another example. So if you wanted to go through another example, right, you can see how it works. It's another soccer academy. Beckham, right? Does he still play soccer, or is he too rich? Okay, now we had one more homework problem to do. Let's look at it. We're not going to do it because it's too long. Okay, now this problem covers everything that we learned how to do going back to really chapter 2, right? So here, the general ledger of Red Storm Cleaners at January 1st, 2021 includes the following account balances. So this is as of January 1st, 2021. Here's the trial balance. The following is a summary of the transactions for the year. So what do they want us to do? First thing they want us to do is to take these transactions and record them. Right? So notice there are 7 transactions listed here, right? There are 7 journal entries they want you to make. Then what? Then they want you, now you have to put the numbers in the accounts, but that doesn't look like they gave them to you, right? So I think on a piece of scrap paper, you should probably list the accounts unless they come later. Let's see what happens. Here's the adjusting entries they want you to make. They only want you to make 3 entries, right? You've got 1 for salaries, 1 for depreciation, and 1 for supplies. Then they want you to do another trial balance after you did the adjustments. Okay, then they want the income statement. They probably want all the financial statements, right? And then close. Closing entries. Remember, there are 3 closing entries. You want to make the revenue account 0, the expense account 0, the dividend account 0. Here's the accounts, right? So they do give you the account. All right, and last but not least, they'll want that final trial balance. It's called post-closing trial balance, right? Post-closing, post means after, post-closing trial balance. So that's what we'll do next time. Now, you know, you shouldn't have to wait for me. You should at least try to get started on that. So this way you're not under pressure to finish your homework because, you know, the homework will be due a couple of days after that. All right, so that's what I had for you for today. Does anybody have any question?
No.
All right, so I'll see you next Wednesday. We'll go over this last problem, and then we're finished with 3. Right, and like I said, 3 is a tough one. 4 is not really too bad. So have a good week, good weekend, and I'll see you next time.
All right. Have a good one.
Professor. Professor.